Hey guys, and welcome back to Smart Money Minds. So what does a marijuana company like CGC, a car company, an electric car company like Tesla, a microchip company like Micron, a gaming company like DraftKings, and a electronics company like Apple all have in common? Well, obviously it's not the ticker, it's not the industry, nor is it any chart history or news, but simply it is this chart pattern that appears over and over again in every different time frame on all different types of stocks. So let's take a look at what it is. This is the easiest pattern to make money. Low risk, high reward, and this is called a bull pennant, or generally called a bull flag. So what is it exactly? It's a pattern that has proven successful time and time again on all sorts of different time frames. So here's what we need to look for. And all you need to look for is three pieces of very important information, which is the price action, the volume, and the Fibonacci retracement. When we see a bull pennant or bull flag, both of these occur after a strong bullish move on the chart. And this is followed by weak bear volume and consolidation, setting up a nice higher low. Bull flags tend to trend downwards. Imagine a flagpole and then a flag forming. So something on DraftKings that looks like this. A bull flag, bull pull, and a flag that occurs. On Apple, same thing is happening. We have a pull and a flag that occurs. Bull pennants are equilibriums that form after a strong bull move. They usually happen with decreasing volume in general and tighten up within a certain price range. So if we look at MU with a bull pennant, this is what's occurring. So you see the bull flagpole pushing up, and we start to see a bull pennant form with a high, higher low, lower high, higher low, and pushing over. There's three touches, and this flag starts to shape up. And as you see, the volume is very low. It starts to trickle down. Look at the bear volume. It is quite low in all these stages. You can see that after a short period of time, the bulls start to come back in with increasing bull volume and start to drive the prices back up, generally breaking out into a new high. So that's exactly what happened on MU. Let's take a look at Tesla. Same thing is occurring. So we got big bull action here. We got low bear volume here, and it's pushing up to a brand new high. So that's a bull pennant, but if we look closely at a bull flag, this is what would be occurring. You see this? This pattern forms, and this channel comes down, but as you can see, very low bear volume during this midday section here before breaking out to a new high with increasing bull volume. The flag can sometimes form a descending triangle, as you see in this pattern here on NEO. On the shorter time frame, on the 5 minutes, we see a descending triangle, which is also a bullish pattern. And you see that the bearish weakness is happening as it gets harder and harder for the bears to push down the prices. So it pushes down here, it pushes down here, and then right here, it forms a double bottom, and you see this triangle, this descending triangle is happening. And once the bears run out of steam, right around this range, it starts to push right back up, increasing bull volume, and it breaks to a new high, and it continues upwards. We're going to talk about the last part of the puzzle, which is using Fibonacci retracement. So we already know volume and price action in this pattern. But with Fibonacci retracement, we get to see how to figure out where to set our stops. Using the Fibonacci retracement also allows you to figure out when the bull flag becomes invalid, because a bull flag usually never retraces more than 50% of the original move. For example, if we use the low of day of this range here, and do a pull up to 6180, which is the initial move, you see here it generally sits at the 0.382 range, and that's where it consolidated to before pushing up to a new high. Here's another one, and this is Micron using the low of day. We're pushing up. Let's take a look. Right here, it hits the 0.5 line. It starts to develop an equilibrium into a bull pennant, and then it pushes out into a new high. Once you see the qualities of a bull flag on a chart, it's easy to make an initial entry that's small with a stop that's below the 0.618, because if it breaks down from the 0.5, it's usually invalidated as a bull flag, so that play no longer exists. For example, let's say I was planning to play this Micron play. So what I would do is I would perhaps have my initial entry at the 0.382, and as it drops lower, I may add a second entry around this range at the 0.5, and what I would do is I would set my stop right here at the 0.618, which is around the 84.50 range, and I'm gonna let this play out. So with this, you have a very clear, definite stop level. And also, as it goes up, you can always be taking profit around this range instead of waiting for it to come back down and break out into a bull flag. Similarly, you can also, for DKNG here, you can make an initial entry here at the 0.236. And once you make that entry, you can set a stop either at the 0.5 here, or you can set it a bit lower at the golden pocket range. That just gives you a very clear, definite stop level to show that the bull flag is invalidated. And once you see that the volume starts to come up, you can always add a second, larger position and really capitalize on this trade. A target exit could be a test of the new high. So as you see here, it just broke out a little bit, if not basically double top, before consolidating again and testing to retry onto a new high. So you can always take profit on this double top, or you can sell half and you can just ride out the rest and see if it continues to break to a new high. We've been talking all about the bull flag, but there's an opposite version of this, which is called the bear flag. It's a little more complicated, a little more advanced, because you have to play short or you have to play option puts in order to capitalize and make money. But bear flags exist, and it's a money-making opportunity. So if you take a look at ZM here, which is Zoom, we see that the bear volume is strong with weak bull volume trying to push it back up. So this is the flagpole at this stage, and we're looking for it to push back up. It gives us a reversal doji candlestick, and it continues to break down throughout the day. So it's very similar. As you see here, it hit the 0.382 on the bounce, and it continued to fade. So Fibonacci retracement works for this as well. You see heavy bear volume, low bull volume, and bear volume continuously dropping the prices down. This sounds like a lot to remember and to practice, but the key points is to keep it very simple. All you have to do is look, if you're looking for a bullish push and a bullish move, we're looking for increasing bull volume followed by decreasing bear volume and a weak pullback. And this is where you know you have a good opportunity for a continuation move back up to test the high, if not to reach a new high of day and a new higher high. If you can hit this trade over and over again, then this becomes your edge in the market. And doing this trade may be all you ever need to be successful in the stock market and to earn money from it. Let me know in the comments below what you believe is the most successful pattern that you've traded so far. If you enjoy this video and would like to learn more, make sure you hit that subscribe button, hit the like button, and we'll see you guys next time for more informational videos.